Hello, everybody, and thanks for joining us. Very excited today to have Raghav join us and look at the all-in-one portfolios. So really the goal today is to have a peek under the hood and have a look at really what goes on under this portfolio. It's much more than a line item, and we really wanted to expose some of these features, what teams are behind it, what's included in the portfolios. So we'll look at all of that today. So very excited to have Sean Sagan and Raghav, who's going to be taking us on this adventure today from Fidelity. And we'll just do a quick intro and then we'll get right into it together. Perfect. So as I'm doing that, just going to have these disclaimers up to keep compliance happy. So we'll be getting into that very shortly. But once again, thank you to all our participants today, and very excited to get into that very soon. All right. This is our team, myself, Pear's on the line as well, and Jeff, and we've got Leah and Joan. So in case you haven't put the name to the face, this is who we are at WWH Financial Group, and very excited to be presenting this today. And we've got a wonderful guest speaker, Raghav Mehta from Fidelity, and he's part of the ETF group amongst many other things. So he's got an extensive career on the financial side, and really happy to have Raghav today and talk about the all-in-one suite and what makes them different, what makes them unique, and what happens under the hood. So thank you for joining us today, Raghav. Very excited to have you.
Thanks, Erik. Thanks for having me. And yeah, looking forward to this as well.
Beautiful. So with that, I will pass the baton over to Raghav, and we'll get into our conversation about these portfolios, what they do, how they work, and we'll take a look through that journey together.
Perfect. And I just want to do a quick check. I hope you can see my screen and hear me loud and clear.
Perfect. Yes, all good.
Awesome. All right. So once again, thank you very much for joining us today. Thanks for having me. Today's webinar, if that's the right word, or presentation, is more about our managed offerings. So we'll talk about our managed offerings, specifically our all-in-one lineup of ETFs and funds with our Fidelity ETFs, and how these all-in-ones or the all-in-one ETFs can help investors construct efficient portfolios when you say long-term investing from the end investor standpoint. And speaking of that, before we dive in, this is what the agenda looks like. So we'll kick it off with explaining a bit of a lay of the land of how the ETF flows look like, what investors are buying nowadays, where the market's headed. We get into a quick market update on the 60/40 portfolio. And then we dive straight into how Fidelity and how Assante can help construct efficient client portfolios from the investor standpoint. We look at a few things like performance, our product overview, to Erik's point earlier. We look under the hood, how these strategies are designed, how the nuts and bolts work, how the strategies are constructed. And then we'll end it off with why Fidelity, why use Fidelity, the benefits or advantages of going with a trusted partner like Fidelity to help run your portfolios and run your day-to-day investments and managing your retirement and investment savings accounts as well. Does that sound good?
Sounds great.
All right, so let's dive into the first piece, which is, if you look at the flows and where the industry is headed, right? I want to talk about flows for the balanced ETFs. When I talk balanced ETFs, when I say what is balanced, it's basically an ETF strategy that's low cost but invested in a combination of stocks and bonds. So that's what your balanced portfolio looks like. And we also call them asset allocation ETFs. So if I look at the flows for asset allocation ETFs in Canada, we found out that asset allocation ETFs have had consistent inflows during the last 5 to 7 years, even during the period of the COVID lockdown when we were all working from home in an extended period of a lockdown. Even then, we saw consistent inflows in this category of funds. And then over the last 5 years, what's even more remarkable that I want to bring to your attention or bring to your notice is we didn't see a single month of redemption over the last 5 years. So more and more investors, more and more advisors, and more clients are using asset allocation funds and ETFs as the go-to solution to instantly design and construct your portfolio from scratch. One single transaction gets access to a 60-40 fully balanced portfolio, and you let Fidelity or the asset manager do the heavy lifting for you, completely hands off from the investor's perspective, and also hands off from your perspective if you're running the portfolio and you're hoping that we give you the best possible results time after time over the longer term time horizon that you might have as an investor.
And Raghav, just to level set, so when we say asset allocation, it's an important term, but for maybe individuals who are newer on this journey, can you explain what that term is so we can carry that definition on as we look at this together?
Yeah, perfect. So what asset allocation really means is, if you design a portfolio, how much weighting or how much of that portfolio do you want to invest in a particular asset class, say equities or stocks, and how much of the other asset allocation or the allocation do you want to allocate towards bonds or fixed income. So it's basically what determines your neutral mix of stocks and bonds. And nowadays we also have other things like private assets or alternatives, whether it's real estate or some private lending or private credit funds. I don't want to get it to the weeds of alternatives, but nowadays it's also a third element, which is your alternative investments. So it's the asset allocation that defines the breakdown of how much of the portfolio do you want to invest in stocks versus bonds versus something else. That's what defines asset allocation. That's what asset allocation means. So when you talk about asset allocation, we talk about the average 60-40 balanced portfolio, roughly 60% invested in equities, 40% in bonds. And again, it doesn't have to be a 60-40. We'll get into that today. It could be 40-60, 70-30, but from a market timing perspective, it's the balanced portfolio that happens to be one of the best performing asset classes versus any other investment type or asset classes in this kind of a market environment that we are in right now. So, we at Fidelity, we love studying trends and patterns. So we went back in time, and during the last 4 rate hiking cycles, we studied the patterns, right? So we compared performance of different investment types, stocks, bonds, your 60-40 balanced portfolio in the 18 to 24 months leading after the last rate hike was done. And then we take an average of that performance during the last 4 rate hiking cycle regimes. Turns out, it's the balanced portfolio. It's the portfolio that invests in a combination of stocks and bonds that turns out to be one of the best performing investments in this kind of a market environment that we are in. So as we get closer to rate cuts in the US, it's the balanced fund that looks poised to be one of the most viable strategy in this market environment. And if you also look at, let's say your balanced fund that invested in stocks and bonds versus, let's say, a 100% bonds portfolio. Let's say you bought either 100% bonds or something more stable like GICs. We also noticed, like I've shown here in this chart here, in times of market stress or large market drawdowns or extreme market volatility, if you had sold at the lows and then invested or rotated into 100% bonds, I'm showing you the performance of a 100% bond portfolio versus, let's say you remained invested in a balanced portfolio, which invests in a combination of stocks and bonds, and you stayed the course and remained invested, you actually do much better over the longer term with a balanced strategy, as opposed to getting scared because of the short-term market drawdown or the large market stress or volatility that you might be undergoing in the shorter span of time in that particular moment. So I think the long story short, the crux is that stay the course, remain invested with a balanced approach to investing with 60-40 bonds and stock combination in a portfolio, and that will give you the results over time, over the longer time horizon. And then again, it's the asset allocation, it's diversification that are 2 powerful tools for achieving an investment goal. So a portfolio's allocation amongst asset classes will determine your large proportion of its return and the majority of the volatility risk that you're taking in the market. So the broad diversification reduces your portfolio's exposure to specific risks while providing opportunity to benefit from the market current leaders, depending upon which way the market's headed in a rally, which sectors are leading. But again, if you remain invested with a combination of stocks and bonds, it will give you a fair amount of exposure to the leaders, as well as other sectors that can actually offset any risks to give you that cushion in the market. So with this example here in the slide, we show a simple example of the relationship using two asset classes, bonds and stocks. And the number in the middle of the bars in the chart shows the average yearly rolling return since the 1980s for having invested in various combinations of stocks and bonds. So the bars represent the best and the worst 1 year rolling period returns. And you can see here, I've actually encircled in blue at the center that what's the best combination of stocks and bonds? How much should you invest in stocks and bonds as a combination within a portfolio? It happens to be the bars in the center with the highest risk-adjusted return or highest Sharpe ratio. And again, it doesn't have to be one specific number or breakdown. It could be anything based on your risk tolerant, your investors' risk appetite. Obviously, the more conservative investors will invest more in bonds, and vice versa. The more aggressive investors or the younger investors can afford to invest more in equities. But then we have a solution for every version, or we have a solution for every investor type, given your risk tolerance, and we'll get into that right away. So if you look at the screen, we have this lineup called the All-in-Ones. The suite comprises ETFs that are also available as F-class and B-class mutual funds. They come in a few different versions. So if you look at the screen, starting from the left to the right, we've got 4 different kinds, from the most conservative to the more aggressive, or the most aggressive one on the far right. So your 60-40, 40-60, roughly 75-15, and so on and so forth. So basically, the more aggressive you get from the left to the right, the more you invest in equities and lower the allocation towards bonds. And again, this is a lineup, so we fully rebalance it for you. It's fully managed, rebalanced every single year, and also in times of large market shifts. And what these 4 funds hold is they hold a combination of Fidelity's equity factor ETFs, as well as the fixed income ETFs in the basket for each of these 4 funds. So if we fully rebalance it, as I said earlier, we manage the whole portfolio and the strategy for you, and we do all the heavy lifting. So if, again, you don't like using ETFs, you can actually go with the Series F and the Series B fund version of the same lineup. And I'll just get into that. And before I do, I want to mention that you don't pay any direct management fee. So again, if I go back to the same slide, all you pay for is the weighted average of the MERs of the ETFs held inside these portfolios. Unlike a lot of our competitors nowadays, we don't charge any additional beeps of management fee. Again, all you pay for is the average of the MERs of the ETFs in the portfolio. And that's only because we don't want to double dip the client or charge the same client, same investor, same advisor twice. And that reflects in the lower cost, and that also reflects in the performance of the funds. Performance is net of fees after all. So lower the fee, the higher net performance or the net returns that you'll get from these portfolios, from these strategies.
And Raghav, is this something that we'll look at in terms of how those different portfolios are constructed at a later time, or is this a good time to maybe just add some color as to what those different buckets are?
Yeah, for sure. So I'm going to skip across. I wanted to cover performance, but I can perhaps skip across. So yeah, so the portfolios, they come in 4 different versions, as I've said. They're diversified across sectors, across geographies, across regions and asset classes. And the ETFs or the funds are rebalanced annually and periodically in case the percentage weights allocated in stocks and bonds, they drift much further away from the target allocations beyond the 5% threshold. So for example, if you look at a 60-40 portfolio, and if the equity markets, rally, for example, and the portfolio or the allocation to your equities is 60%, for example, that rally makes the portfolio shift or drift greater than 5%. Let's say, for instance, the market rally and that 60-40 portfolio became almost like 70-30 with a 10% allocation. So we'll jump in right away in that scenario, and we'll rebalance instantly to bring it back to the neutral 60-40 mix. So that's one thing, that's one component of how the portfolios are balanced or rebalanced from the investor standpoint. And then obviously, if it stays in that 5% band, we let it run until it hits the 5% threshold, because again, we don't want to rebalance it too often and too frequently to obviously minimize your portfolio turnover costs and then keep the funds at a lower cost from the investor perspective. Now, if you look at what's the makeup inside these funds, they are invested in a risk-controlled and a disciplined manner, which is really around minimizing volatility, optimizing volatility. So we don't want to take too much risk, and at the same time, we want to protect clients' capital or the wealth, yet yield the highest possible positive outcome with the right range of positive expected returns in accordance with the risk tolerance or the risk that you're taking with that particular investment strategy out of the four portfolios that you choose, right? Depending on the investing style. So obviously, the more aggressive it gets, you invest more in equities, and the less aggressive you get, you invest more in bonds. And if I talk about the equity allocations, we hold equity factor ETFs, and I want to go back to this slide. So on the equity side, we buy low volatility, high quality, momentum, and value stocks with the factors. And on the fixed income side,
Raghav, do you mind maybe just giving an example of what would fall into those buckets, just to paint a picture for clients and individuals who own these funds?
Yeah, perfect. So with that, I want to, I guess, address this question in a different way. So I want to first define what is factor, what is smart beta. So, on one end of the spectrum, if you look at how mutual funds exist in the marketplace, on one hand, you have your actively managed mutual funds that are really generally, they seek to outperform the broad market. And then on the other hand, you've got your passive funds, which generally track a traditional market cap weighted index. Now, what the factor is somewhere in the middle of the both extremes. So where the active meets the passive, best of both worlds, neither completely active nor completely passive. So factor resides at the cross section or the intersection of both the styles, both the extremes. And that's what we call smart beta systematic, or that's what's called a factor. So it's basically our mathematical geniuses, our statistical wizards, our geeks from MIT, Harvard, Stanford. We also call them quants or financial engineers. So they use mathematical models and statistical rules, so math and science and statistics, to screen for the most attractive, most compelling stocks, which we filter for, and then we pick the best stocks or equities using these mathematical statistical rules, using a transparent quantitative process. So these quants, these financial engineers, they design these models and the quantitative methodology behind the scenes, which is created to give investors exposures or access to the best stocks, best equities, given by or driven by certain characteristics or targeted attributes. And what are those targeted attributes or characteristics? So again, that's what we call style factors or factors. So for example, the dividend factor on the far left is nothing but the characteristic dividend yield that defines a stock. So in that case, the models will screen for the stocks with the highest possible dividend yield and then dividend growth. Similarly, if you look at the quality factor, that, as the word suggests, quality, that means financially healthy companies. We'll pick stocks with companies having highest possible return on invested capital, highest possible free cash flow margin, profitability, and earnings growth versus the peers in the same sector, for example. And then value, as the name suggests, looks at securities that are underpriced, inexpensive relative to their intrinsic fundamentals. So companies with lower price to book, price to earnings multiples. And again, momentum basically means winners that continue to win and avoiding losers that continue to lose. So again, we pick companies that have a positively trending price momentum. Look at names, for example, like NVIDIA, or the big mega cap tech stocks, the Magnificent Seven. Those would be some examples in the momentum or the growth category. That's what we call momentum. So again, that's how we run the factors. It's all our quants and financial engineers that are doing all the heavy lifting for you. And then we combine these factors. I'm just going to go back to that same slide where I had the four versions. So again, this is how we design the portfolio, by combining the factors. So you have all of the five factors: quality, momentum, value, and also small cap on one hand. And then on the other hand, you've got the actively managed bond ETFs. So there's one product that invests in global bonds, global core plus, as the name suggests. And then the other one is systematic Canadian bond that's primarily invested in all domestic bonds of the highest quality, of the highest Sharpe ratio. And then again, we combine all of those factors and the bond ETFs to fully design a portfolio from scratch. And that's only so that investors get access to a completely strategically diversified portfolio that's rebalanced and fully managed by Fidelity. So we do all the heavy lifting for you. And again, to give you the best possible return outcome for the amount of risk that you're taking in the market.
No, that's great. I mean, and just to highlight, that's one of the real benefits that we see, and why we're putting some of the new clients in this is, one, you get the balance of automated rebalancing. So you don't have to go in and make sure that your portfolio is balanced. This has this feature. So that's a wonderful feature. It has some guardrails built in. So it maintains that asset allocation that we've landed upon. The fees are very reasonable and quite low, and you get global diversification across classes. So those are really three of the big reasons why we've started to use this and implement this. So thanks for bringing that out, Raghav.
Perfect. I hope I covered everything that you wanted me to talk about so far. And I also wanted to get into the weeds of performance, right? Again, I don't want to keep on yapping and not talk about how these strategies have performed over time. If that's okay for you, or is there anything else that you want me to cover before we do that?
No, that's great. We'll look at that, and then maybe we can talk about some of the flows, and then we can wrap it up there.
Perfect. So again, I want to talk about performance of this lineup relative to our peers in the marketplace. You look at iShares, Vanguard, BlackRock, McKinsey. These would be, some examples of our peers who are running similar products, similar strategy in the balanced or asset allocation ETF space. And every year or every month, our performance gets ranked depending upon what time period we are looking at performance for, whether it's 3 months, 6 months, 1 year, 3 year, or even since common inception. And then for that respective category for each of these 4 funds, our performance is ranked against our peers that belong to that same category in that respective time period. And time after time, as you can see here in this slide, in this chart, we are almost 100%. In fact, not almost, we're actually 100% peers beaten in certain time periods, 6 months, 1 year, and since inception, as well as 3 years. If not 100% peers beaten, we are in the top quartile, or even north of the 90th percentile, which means we are actually beating over 90% or over 95% of our peers in the industry when it comes to performance of these funds in our respective categories. And that's why we've been awarded recognition and accolades with 5-star ratings by Morningstar, as well as the fund grade A+ rating by Fundata. And if I talk more about performance, speaking of performance relative to top competitors, whether it's Vanguard, iShares, BMO, these would be some examples of the top 3 names. Our performance has continued to be impressive with this suite. We've consistently outperformed Vanguard, BMO, iShares over the 1 year, 2 year, 3 year, and since common inception, as well as most other time periods. If you look at standard period returns on this chart here, with the portfolio providing an excess return over all of our competitors. Now, this is one of the 4 versions. I think this one is the balanced one. Yes. And then if I look at the growth one, which is the slightly more aggressive of the 4 versus the previous one, which has more allocation towards equities and less towards bond, it's the same story here as well. Consistently outperforming our peers in that space as well. Vanguard, iShares, BMO, if you look at the numbers and the performance here in the chart, in the slide. And last but not the least, if I also look at FEQD, which is the most aggressive one of the 4, it's the same situation, same story. We are consistently outperforming Vanguard, iShares, BMO. These would be the top 3 competitors or contenders in this space, with the largest strategies that they're running as well in that same category, where we are ranked based on our performance. So again, we are doing all the heavy lifting for you from a performance standpoint, and we are making sure that your capital grows consistently time after time with the highest possible expected return for the level of risk that you're taking in the market. And again, performance, or the proof is in the pudding. So if I also talk about flows and the kind of success that we've had with this lineup, the all-in-ones are experiencing tremendous growth, substantially faster than the industry average, with our AUM more than tripling in 2023, which was last year, to north of 1 billion. And the most impressive aspect of our previous year's growth is that these flows came from before the balance and the growth strategies even crossed the 3-year milestone or even completed their 3-year track record. So this isn't as surprising after you compare the performance versus our passive peers like iShares or BlackRock. And then again, this chart needs to be updated. So last time we submitted these slides with compliance, it was back in April. We've actually crossed the 2 billion mark in terms of our total assets for this suite. And that tells you or speaks volumes for the amount of success that we've had with this lineup of funds as well.
No, that's great. And Raghav, are you able to share, are there any thoughts as to why there's outperformance? I mean, can you share, is there any insight that you have that can explain some of that in terms of what we're seeing in the numbers?
Yep. So one reason that I normally talk about whenever I do presentations, and my job is to travel across the country and I meet with advisors and clients alike to offer them portfolio consultation, right? How do we improve your portfolios from a wealth management standpoint? And I compare our lineup versus iShares, Vanguard, McKinsey, CI. There's one thing that's very striking here is if you look at this piece over here and each of these 4 pieces in the asset allocation, we actually have a large overweight to US equities, whereas a lot of our peers in this space, whether it's iShares, Vanguard, McKinsey, they actually have a global or globally diversified mandate, but not as much of an overweight to US equities. And in this last couple of years where, before the rate hikes actually started, that's when the US equities had benefited from a lot of the cheap money, lower interest rates, and all the US tech and growth stocks rarely getting, the benefits of the highest possible returns in that kind of a market environment. That's what's actually helped in our favor. In fact, if I show you or I talk about the most aggressive version of the 4, we actually have close to 50% US overweight in US equities. And that's the highest overweight that we've got versus our peers in the industry. If you compare our all-in-one versus our competitors or peers all-in-one. So they might not call or brand them as all-in-ones, but if you look at the asset allocation ETFs, we might have the largest overweight to US. And that's what actually helped us outperform. But then again, on the flip side, in a rising rate environment where, the US equities or going forwards, the stocks might get affected in a higher for longer environment, potentially. Even then, if you look at recently, our performance has been stellar. We are still outperforming our peers, even in a higher rate environment. And that goes to the fact how we've constructed our factors. Our factors are meant to even perform consistently, especially factors like the quality factor as well as your value stocks. They actually helped push the portfolio forward from a total return standpoint, even the last couple of quarters.
And then one more note as this pops out through the neutral asset mix. Can you speak about how the crypto side is managed? Are there any guardrails on that? Is it simply Bitcoin, or what else goes into that? If you can just speak a little bit as to how the digital currency side of things is managed with these portfolios.
Yeah, perfect. So on the crypto side, we only hold the Bitcoin, and that is basically FBTC. That's our Fidelity Advantage Bitcoin ETF, where it's the Fidelity Clearing Canada, our custodian side of the business that stores the cryptocurrency and mines it in our cold storage in our own secure wallets, so to speak. So we don't rely on Gemini or Coinbase or any other third-party custodians that might have gone bust. One example that comes to my mind is FTX and whatever happened there over the last couple of 18 to 24 months or so. So it's our own in-house infrastructure that's running the Bitcoin allocation, and it's ETF. The ticker is FBTC. You can even buy that ticker or ETF if you want to invest in Bitcoin standalone. So in each of these 4 versions, we have 1 to 5% or 1 to 3% Bitcoin invested based on the asset allocation or the allocation in crypto itself, with the highest one and the most aggressive one being 3%. and yet we have a 5% risk cap. So in a scenario where Bitcoin rallies and it kind of breaches that 5% level, we'll jump in and we'll rebalance it right away. Why? Because we don't want to take too much risk in the marketplace. As well as the other thing, so in 2022, when the rate hike started, Bitcoin or crypto was the worst performing asset class. And then on the flip side, in 2023 and 2024, after that, Bitcoin was actually one of the best performing asset classes. So regardless whether it's a bullish environment or a bearish environment, we've always tried to take advantage of the market momentum, regardless of what sector we're bullish or bearish on. So if you look at 2023 and 2024, this year, Bitcoin being, or crypto in general being one of the best performing asset classes, we actually went a little higher slightly in our allocation to tap into that upswing or momentum in the crypto space and take advantage. And that's what's been driving our performance or outperformance more recently. Whereas in 2022, when crypto was one of the worst performing asset classes, we were quick to actually trim our allocation down to as little as 10 basis points in one of the most conservative strategies out of the four. And yet we were actually outperforming our peers in that period, the peers that have no Bitcoin allocation. So that speaks to the fact that, yes, we have Bitcoin. In some years, it was the most hated asset class. In the other years, it was the most loved asset class like this one. Yet we are making sure that we are taking advantage of the market opportunities and trying to get the best possible return outcome from the investor standpoint.
Great.
If that answers the question.
Yeah, certainly. I think another one of those assets of this type of portfolio is that component, if you would like that, is actively managed. So you don't have to go in and make sure, is this a good time to buy or sell? It's actively managed. There are guardrails set up. So a nice feature within these portfolios. So thanks for highlighting that, Raghav.
Precisely. And then one thing that we've kind of included is a small enhancement. We've added a sleeve of small caps as well. So small caps give you that attractive upside. Whether you're a contrarian investor or not, we see relative value in small cap. In fact, right now, given the market environment that we are in, if you look at this chart, small caps are actually trading at the biggest discount relative to large caps and mid caps over the last 20 years. So it's never been this cheap, historically speaking, trading at 30% below its long-term average. From a relative valuation standpoint, the last time small caps were actually this cheap was over 50 years, or in those 50 years was when we had the dot-com bubble earlier. So that was the last time when small caps were historically this cheap. And then if you also look at market timing, history tells us, historically speaking, that it's the small caps that actually outperform in the 6 to 12 months after the first rate cut in the US, with an 83% probability and the highest possible hit rate or batting average. So again, if you care about market timing, small caps look poised to outperform in a recovery rally. So with that being said, we included the Global Small Cap Opportunities Fund, which is actively managed, run by Connor Gordon and Chris Maludzinski. Outstanding track record, high conviction portfolios concentrated in 40 to 80 names with 90% active shares. When I say active shares, which means it's invested in names that you would normally not come across in the S&P 500 or any other small cap index as well. These are your hidden gems that Connor and Chris try to find or uncover in the small cap space. It's a global portfolio invested in high quality names with a value tilt, and where companies are mispriced from a valuation standpoint, with a positive catalyst for change. And again, if you look at track record of the small cap ETF itself, it's got 97 to 98% peers beaten, and 90% of the excess returns directly attributed to stock selection. So it's your real alpha generator. And we thought we'll include this in the portfolios because, what this means is, if you look at asset classes and market performance, you have different investments, whether it's small caps, bonds, emerging markets, US equities, Canadian equities, you name it, right? Different investments perform differently in different time periods, which means not every investment type gives consistent results time after time. But if there's one strategy that works, is it's combining all these investment types into one global diversified portfolio with the right mix, right combination, and the right level of diversification to give you that improved risk-adjusted returns, like your all-weather investment portfolio, which is what we call the all-in-one. So that's what the all-in-ones are doing. Because the reality is, having stocks and bonds in the same portfolio, the bonds can provide the cushion or the benefits of diversification that can help stabilize your portfolio returns, right? This chart illustrates to us that bonds can actually enhance performance by providing a source of returns that has a lower correlation to equities, especially your investment grade and high yield bonds that have actually outperformed in every calendar year that the S&P was down since the 1920s. And the investment grade bonds actually generated positive returns in 22 of the 24 years when the S&P 500 was down. So yes, the bonds are just one of the many tools that are available to you to get you that diversification benefit in your portfolio. So with that being said, this is the lineup, and I'll probably end it here. This is the lineup. And again, if you don't like to buy ETFs, I've got the fund codes listed here, Series F and Series B, and you can invest in the same strategy through these fund versions as well. It's approximately same price points, 30 to 40 beeps in terms of the MERs. And again, giving you that broad market exposure, low cost diversification. And again, with Fidelity, you get the benefits of active management as well as a time-tested, research-driven investment approach or approach to investing and picking the best names.
That's great. Thanks for sharing that today, Raghav. So just wanted to thank Raghav for sharing the time. I mean, really, the goal today is just to go under the hood to look at what makes this holding unique. What are some of the features? Because often we'll see one name on, I'll say, a statement, but there's a lot more that goes into that. So I think as Raghav was sharing today, there's an active component, there's a diversification component, there's active rebalancing, all of which is included at a low fee. So a really nice solution to add to the investment portfolio, something that we've started doing with some clients. So really wanted to go under the hood, peek, and see what makes this product unique and what are some of the features. So we really want to extend a big thank you to Raghav for sharing the time today, for Sean Sega and the Fidelity team for all the support. Very much appreciated as always. And on that note, on behalf of Per, myself, Jeff, Leah, Joan, and the WWH Financial Group, just wanted to thank you for watching. Thanks, Raghav, and wishing everybody a great rest of the day.